Here to dive into industry trends with leading ETF experts, this is ETF Spotlight with Nina Mishra.
Hello and welcome to ETF Spotlight. I'm your host, Nina Mishra. My guest today is Meb Faber, co-founder and CIO of Cambria Investment Management. Meb also hosts the popular Meb Faber Show podcast, which is awesome. And he has authored numerous white papers and books. Today, we are talking about the 351 ETF exchange, which basically helps you defer taxes on your legacy stock positions with huge capital gains. Meb, welcome. It's a pleasure to have you here.
Excited to be with you guys.
So we know that ETFs have surged in popularity for so many reasons, including transparency, intraday liquidity, low fees, and tax efficiency. And now there's one more reason to love them, especially if you have got stocks in a taxable account that have climbed a lot in value over the past decade. And it's been such an awesome bull market. So if you want to diversify, selling those appreciated holdings and moving into an ETF would normally trigger a hefty tax bill. But the good news, now you can use a 351 ETF conversion to turn your stock portfolio into a diversified ETF without triggering those capital gains taxes. And Meb, you're the perfect person to talk about this topic since Cambria recently launched their third such ETF. But before we get into 351 exchanges, let's set the stage. So could you give us a quick overview of the tax advantages of the ETF structure, especially for someone who might not be very much familiar with the in-kind creation and redemption processes?
Yeah, so, you go way back to the 1990s when sort of the ETF was born in the United States. And it's really kind of an amazing structure. For the longest time, if you had investments in stocks or a mutual fund and you traded them, you had to pay taxes on if you had gains on that turnover, which is no fun. No one likes to pay taxes as you go. And so the ETF structure figured out a pretty clever way to defer that. Now, you're not avoiding it. That would be illegal, of course, but deferring it down the road. And so if you look at something like the SPY, which has been around for like 30 years now, it's really never paid a capital gains distribution. And so and it's not for all ETFs, but for most of them, the normal ones, that difference alone, if you add up the tax benefit, if you're a taxable investor, and the fee differential, mutual funds come along with so much baggage and so many conflicts of interest and fees. Everyone's got their hand in the pie. Bank of America, I think, estimated that the benefit is like 1.5% a year just from moving from mutual fund to ETF structure. So we love that what we call tax and fee alpha. Everyone loves to talk about the investment alpha, what's gold going to do, or stocks expensive, it's the Fed lowering rates, on. And that's the hard part. The easy part is just avoiding really high fees and Uncle Sam on the tax side. So the ETF structure has been a huge, massive benefit to individuals and institutions alike.
Yeah, that's the beauty of the ETF structure. Now let's talk about the 351 exchange. Please walk us through how the 351 to ETF conversion works.
Yeah, the problem, even if you have a tax efficient ETF, first of all, let's set the stage. It's the best time ever to be an investor. There's limitless choice, fees are super low, but the last 15 years have been unbelievable for U.S. stock investors. One of the best periods in history. Really only, if you look at it on a rolling 10-year basis, there's only really been 3 periods like this where U.S. stocks have done 15% a year for over a decade, and they all have names. So the Roaring 20s of 100 years ago, the Nifty 50 stock period, internet bubble, which was my favorite, of the late 90s, and then, of course, COVID meme stock mania, whatever we're calling this today. So it's been an amazing time. If you were invested from the bottom in 2009, you're sitting on a 10-bagger. 10 times your money on U.S. stocks, and I think if you're in the Qs, it's closer to 20. So that's the good news. The bad news is you got a bunch of gains, and imagine if you were in NVIDIA or the Mag 7 or something, you have even more gains, which is a great problem to have, but it's still a problem because a lot of people are looking at the market today, like we do, and say, wow, it's super expensive. The valuation on US stocks is probably on par with the late 90s. Some measures higher, some measures lower, but not cheap. And so a lot of people say, I'd love to sell. I'd love to sell my SPY or Qs or Mag 7 or whatever it may be, NVIDIA, but I can't because the tax man will kill me. And a lot of people let that decision kind of rule their allocation. And the problem, of course, comes if and when you have a bear market and all of a sudden those investments are down a ton and you don't have any more gains. Anyway, so what can you do? Well, historically, it's you sell, pay the taxes, move on. But there's sort of a new route, which we like to compare it similarly to 1031 in real estate. So if listeners have heard of that, it's been around in the tax code forever. And 351 has actually been around the tax code forever. It goes back to the days when we were all farmers, and the three of us get together and I bring the tractor and you bring the barn and, someone else brings the seed and we start a new company. Well, that shouldn't be a taxable event. And really 351 found its perfect spouse with the ETF structure and really starting in 2019, because now you could essentially contribute stocks or ETFs, so it has to be publicly traded, to the seed or the launch of an ETF and get the ETF back and that not be a taxable event. So again, you're not washing your taxes, but let's say you contribute 20 stocks, you get the ETF back and it just defers your taxes. And then you have an ETF that can rebalance efficiently and hold it for many years till the one day you want to donate it, sell it, pass it along, etc.
Yeah, that sounds awesome. And I believe there are certain diversification requirements on contributions. And I'm guessing that if I have a portfolio of, 1 million in NVIDIA stock and just say 5,000, 10,000 in other names, that wouldn't qualify for this conversion. So walk us through the diversification requirements.
Yeah, look, the regulators are smart. They don't want people doing this for tax reasons alone. So you have to contribute a diversified portfolio. And there's two main rules on that. The first is the biggest position can't be over 25%. So if you got 10 million NVIDIA, you can't just give me all your NVIDIA. Second is the top 5 positions can't be above 50%. And we got a lot more information. If you go to Cambria Funds, we have a whole 351 page with papers and videos and podcasts. But so basically the reality is you either need a portfolio of about 12 stocks or, and this is a big or, ETFs are pass through. So theoretically, you could give us 100% SPY because it looks through to the underlying portfolio. So if you had that NVIDIA, say 2.5 million, you could then also contribute 7.5 million on the SPY, and that would be a perfectly reasonable contribution. A lot of people ask stuff like, hey, can I contribute mutual funds, hedge funds, private investments, futures, options, all that stuff? The answer is no. It really needs to be a liquid, tradable, public market stock or ETF. And depending on what the fund does, we have one coming out in December that's US only, so you can't contribute foreign stocks. And this will be our 4th. But if you have one that's an allocation fund, theoretically, that could take things like Bitcoin or REITs, on and on. So it just kind of depends on what the universe of the underlying strategy is.
Could you talk a little bit more about tax consequences post-conversion? Because investors are not really avoiding paying taxes. They are deferring taxes and they'll pay much later when it is more convenient for them.
This is a really cool feature. So there's kind of 3 or 4 use cases on why someone would contribute to seed an ETF. The first, that's the most obvious, is concentrated portfolio, which you hit on, where, hey, someone's like, hey, I'm an NVIDIA millionaire, but that's it. I don't have a whole lot else, and I don't feel diversified. I don't want to go the way of Enron or AOL or who knows what, pets.com. Second would be your allocation is just out of whack. So if you were a 60-40 investor back in 2009, well, you're now 90-10, meaning US stocks and bonds, just because they've gone up so much. So you may want to get back to your target. There's some other more esoteric areas for professionals. So like direct indexing, if you're long only, you're kind of stuck. And also for the financial advisors out there, like I guarantee you've talked to many investors who say, look, I have this big position over here, but I'm not going to give it to you because you can't do anything with it. And I don't want to hear about your exchange from Eaton Vance or Goldman. They're too expensive. They're going to charge me 2% a year, on and on. So it's an interesting prospecting. But the cool part is, so let's say you do submit your 12 stocks or your ETFs or whatnot. You get back the ETF, and the ETF, you now have 12 line items with all the different cost basis of what you contributed. So that allows you to pick and choose the tax lots to manage going forward. So say you say, well, I want to sell some of it, but I'm going to sell the tax lots that have maybe the least gains, or et cetera, right? So it gives you a ton of flexibility. It's a really cool feature. And then once you have the ETF will rebalance. Ours are all quantitative, rules-based. So they do it on a schedule, and those rebalancing features will not, I can't say guarantee, of course, in our world, but should not, on average, cause any capital gains events. There's obviously dividend yield and income for bond funds, and that always gets distributed. But as far as capital gains, yeah, they should be deferred until you decide to sell or pass along the ETF many, many years from now.
So exchange funds that do something similar, they have been around for a long time, probably decades. So how is this process different from an exchange fund?
Yeah, so there's a handful of ways to think about tax. And exchange fund has been, really since the 70s, this idea that you could contribute stocks to a portfolio. And again, these were the domain of like Goldman and Eaton, or I think are the two big ones. And you have to stay invested for 7 years. And at the end of 7 years, you get the portfolio of whatever was contributed. So Goldman, for example, would say, all right, I want to get 50 people to contribute stocks. I want them to be diverse. So everyone contributes, and it ends up looking like the S&P or the NASDAQ or something, but it's a diversified portfolio. There's also a weird requirement. You got to put 20% in something illiquid, which is usually REITs or something real estate related. And then in 7 years, you just get the stocks or whatever people contributed. There's a couple of problems with those. By far, the biggest one is historically they've been very expensive. So there's setup fees, there's annual fees, and usually, this is in the domain of 1-2 percentage points per year. For example, our next 351 is 25 basis points, so 0.25% all in. So much, 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 much cheaper. And so, it's not to say that it's a terrible choice, but historically it's been very expensive. And then a bigger problem for the 351 contributors has been, if you got NVIDIA, they probably won't take it because that's all that people want to contribute. No one's probably contributing Home Depot or Berkshire or something that's really going to diversify, or some utilities or healthcare that, on and on. So it's hard to find the ones that it's a problem with, like, if you have the stuff that you want to get rid of, nobody wants to take it. So historically, and there's huge minimums, you got to be a accredited investor. For ours, you don't, on and on. So it's not that it's the worst thing in the world. It could be workable and could be a good fit for investors, but we think the 351 is a much better, much cleaner solution.
Sure. So could you briefly walk us through the 3 ETFs that you currently offer? And I also understand that there's basically an enrollment period where someone can request a 351 exchange into one of these ETFs before it's seeded. So it's more like a one-time opportunity rather than an ongoing process, right? And in that case, can you tell us about the upcoming fund launch that you mentioned earlier and that investors should keep on their radar?
That's a great point. The 351 opportunity is only at the seed of the ETF. Once the ETF launches, it's like any other ETF out there. People can buy and sell it, on and on. So just to back up for a second, Cambria, my company, we've been around for 20 years. We've been launching ETFs for over a decade. We have over $3 billion in assets, over 100,000 investors. And by the end of this year, 20 funds. I can't believe it. That's so many. I used to only think we would have 2 or 3. But we keep coming up with crazy ideas. And so about a year and a half ago, when we started to go down this 351 path, or 2 years ago, we said, we're going to lay out, no one's really doing this open enrollment. So we partner with our good friends, Wes Gray at ETF Architect. And we said, let's lay out a menu, a buffet, if you may, of 4 funds over the course of the next year that people could opt into and pick and choose. And we'll, kind of refine the process, figure out, educate the world, because 99.9% of investors, professionals, venture capitalists, family offices have never heard of this still to this day. So if you're listening to this and you've heard of it before, congratulations, you're more educated than any of the CFAs, CFPs that I talked to for the past 2 years. So the first one we did was a U.S. stock fund. It was an interesting fund because it was focused on U.S. value companies that pay low to no dividend. And this is based on an old paper we wrote a decade ago about taxable investors who actually don't want dividends, particularly if you're reinvesting them. So think about Berkshire, for example. So that fund raised about $30 million. And then our next fund was an endowment style asset allocation fund. So trying to mimic the Harvard and Yales of the world. That one raised $100 million. So getting bigger and bigger. And then the last one we did last month was a global stock fund. And that one raised $150 million. And the one we're doing in December is a US only stock fund. And I imagine that this one will probably raise, I don't know, 500 million to $1 billion. And the way that it works, so let's say you're listening to this and you're interested, there's two big criteria. In the early days, you could be an individual and just submit. And then the custodians like Schwab and Fidelity were like, whoa. This is too hard. We're not dealing with this. You got to go through an advisor. So number one is you have to go through an advisor. Second, if you don't have an advisor, email us. We'll help you find one. We know some that will work to really streamline this process and help you out. But basically, you say, hey, look, you talk to your advisor, you talk to us, say, here's my portfolio. I read your FAQs and summaries and launch kit. I understand how it works. I understand I got to submit a diversified portfolio. Here's my portfolio. Is this going to work? And we have like an online software tool we can run it through. It's pretty slick. And we'll say, look, yes, it qualifies. And so let's say it qualifies. Then, this one's launching, I think, December 18th. So basically by Thanksgiving, you have to have submitted the portfolio. And then you want to stop trading in that account for the weeks before launch. And then, you got to sign a couple forms. It's actually pretty smooth at this point. Some custodians are much better than others. Schwab, for example, is really on board with this and streamlined. And then, your positions transfer out of your Schwab account. And then the day of launch, you get an ETF back and it's as clean as that. And off we go.
Great. Now, switching gears a bit, you mentioned earlier that US stocks are quite expensive. And I've seen some of your recent notes also. It seems you're a big believer in international diversification. And this year, in fact, international stocks have done quite well. And that is after so many years of underperformance. Do you still believe that most investors are too heavily exposed to these mega cap US stocks and they should be adding international equities now?
Oh, baby, no question. It's funny. So we talk a lot about home country bias, and that's the tendency for anyone who's located in a country to put all their stock investments in that country. So Americans do it, Japanese do it, Indians do it, Chinese do it, Brazilians do it. And it's a horrible, no good, terrible idea. Because we live in this global world with tens of thousands of securities. There's no reason to invest in one country. Now, the US has been exceptional, no question. But if you go back the past 120 years, there's been plenty of periods where the US has been one of the worst performing stock markets. And so a diversified portfolio traditionally has been a much better place to be over time. And US versus foreign has traditionally been a coin flip. Now, people look at the last 15 years and say, no, they extrapolate that forever. Well, the reality is the 10 years prior to that, the 2000 decade, everything crushed US stocks. And so we get to a point where back in 2009, we love to talk about the 10-year Shiller PE ratio. It was sitting at about 12. And I don't know anyone that was screaming off the top of the skyscrapers that you got to buy stocks and go all in, right? The world was ending. Lehman was going under, on and on. but stocks are screaming cheap. And here we are 15 years later, where that 12P ratio is now 40. And that's only been eclipsed once in history, and that was December 99 when it was at 44. And so if you look at the opportunity set, we've built out, and we have a research service called the Idea Farm. We've built out global valuation for all the stock markets in the world. And the bad news is U.S. market cap is expensive. The good news is value stocks within the U.S. look much better. And so we do shareholder yield portfolios. So small and mid look much better than the mega, but also foreign and emerging on average look much better than the U.S. And so their valuations are kind of mid-high teens. But the cheapest bucket, which is global deep value stocks in countries like, Singapore, Brazil, Turkey, Poland, those stock markets, which have a PE ratio of about 12, so way less than the US, that bucket is up 40% this year. And so very quietly, you have this value trade just going moonshot, but no one's talking about it. And the reason why is the US stock market's still at an all-time high. NVIDIA's at an all-time high. Everyone's fat and happy. Everyone's, cruising. And until the US kind of, sort of goes sideways or down, no one's going to really notice. The only other thing people seem to be talking about is gold, which is also astonishing, knocking on 4,000, which people are also under allocated to in the US if they have any at all. And so we often tell people when they look at US portfolios, we say two big things that are missing. One, they're always dominated by US stocks and bonds, and that's it. So you got to go global. And of the global index, the US is roughly 2/3. So you should at a default starting place have at least 1/3 in foreign stocks, and no one does. And we often tell people, we say, by the way, US as a percentage of world GDP is only 1/4. So you could make a valuation argument that you should have more than 1/3 in foreign and emerging. My son's 529 is entirely foreign stocks, so he may not be going to college, but look, he's young, so he's got plenty of time. And then the second part is most people don't have enough real assets if they have any at all. And so when I say real assets, I mean things like precious metals, tips, REITs, commodities, commodity equities. Those are the two big missing pieces. But we've long been talking about foreign stocks, and very quietly beneath the surface, as people start to open their account statements and review after the first 3 quarters of this year, they're going to start to notice and say, oh man, the conversation with the financial advisors is going to shift from, why do we own emerging? Why do we own foreign? Are you an idiot? To tell me, why don't we own more emerging and foreign? You're an idiot, right? So we'll see if the flows start to shift in the sentiment, but it doesn't seem like it is yet.
Not yet. Excellent stuff, Meb. We'll have to leave it there, but thank you so much for joining us today and for sharing your insights. And congratulations on all the success.
It's been a blast, and we'd love to say, go Dodgers.
That was Meb Faber of Cambria Investments. The 3 ETFs that we talked about: Cambria Tax Aware ETF, ticker symbol TAX; Cambria Endowment Style ETF, ticker symbol ENDW; and Cambria Global EW ETF, ticker symbol GEW. Cambria also offers many other excellent ETFs, and he talked about the importance of global diversification, particularly how attractive value stocks are currently in international markets. So Cambria offers a global value ETF. The ticker symbol is GVAL, and this is up more than 40% this year. And another ETF that is worth a look is Cambria Foreign Shareholder Yield ETF. The ticker symbol is FYLD, and this ETF has also done quite well. It's up about 25% this year. Thanks for listening. If you like our show, please leave us a rating on iTunes or wherever you get your podcasts. Make sure to subscribe so that you do not miss any episode. If you have any comments, questions, or suggestions, please email podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.